We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Coleman from Idaho Armored Vaults. How are you today, Bob?
Good, Tom. How you doing?
Excellent. Thanks for joining me again. Always great to have you and go over some of the real nuances in the world of the metals here. So we wanted to tackle the big question today of why and how does the physical gold and silver market continue to be engulfed by the enormous world of paper gold and silver derivatives. This, of course, is the title of the article that you recently wrote. And I think it's a really interesting topic to really walk through to help people understand what is really, let's say, driving the prices, creating demand, and where that's all coming from, right?
Yeah, definitely. The financial industry obviously is a very lucrative business. The idea behind it is gathering assets, collecting fees on those assets, and then you have that business model of just constantly growing the assets under management. The problem you have with real assets versus paper assets is that real assets are finite. Paper assets can be created at will. On top of that, other paper assets or other derivatives can then be used to offset or hedge those paper assets or derivatives. And so it becomes this almost like I hate to say it like with cryptocurrencies, but this model of derivatives, like Buffett says, they're financial weapons of mass destruction. Very similar in nature is that, these things have just grown into a monstrous industry. And so what I did was I looked at an article. Well, I was going to create an article and kind of talk about how this actually unfolds and how does the derivatives market or the paper world have so much influence over the real asset world. And lo and behold, kind of came across this. Actually, it was created in Europe in the mid 80s, which was what they call UCITs. It stands for UCITS, stands for Undertakings for Collective Investment in Transferable Securities, which is a mouthful.
It's not something you just need to go to the doctor for.
Exactly. Yeah. It's like, what? It's almost as bad as trying to read some of these derivative products like buffered notes and things like that are issued by some of the big banks out there for structured derivative products. But basically, what Europe tried to do back then was create this uniformity amongst all the European countries as they were trying to create this grand scheme of, okay, if we're gonna try and tie all these countries together under a common theme, well, we have to also do that with investments. And so what makes it difficult with real assets is, one is you have to have the real asset, but two, you have to have some common regulation. You have to have some type of regulatory oversight on how those products are sold. It's a financial industry that you literally have to create. And that's what this UCIT sort of investment class basically was created for, to try and say, okay, instead of getting into real assets, taking delivery of real assets, we're going to create this sort of structure that you have to follow if you're a fund or a pension that has to be compliant in this regulatory framework. And so it creates this, the industry has just grown enormously. You have BlackRock and now you have all the big players that are supporting this industry, creating products some of us have never heard of before. I mean, GLD and SLV, for example, aren't even UCIT compliant. You're talking products that are just literally, in most instances, just derivative based. If it's gold and silver, for example, it may be a fund that invests in futures contracts to get the price representation. Or if it's a fund that invests in real assets, the UCIT fund itself, the investor, would not be able to take physical delivery. And it's one of the things I mentioned in this article, like with PSLV. PSLV, for example, of Sprott's Silver Fund, has language in their offering agreement that says if you're a UCIT compliant fund and you want to redeem shares, you can only do it for cash if you're UCIT compliant, and then you only get 95% of whatever that redemption is, not full 100%. So that kind of starts to funnel all this money into sponsored products, derivatives, where these industries make a crap load of money in terms of spreads and markups and other types of hedging products and financing and collateralization, all that kind of stuff.
So, Bob, are the level or quantity of derivatives on the underlying precious metals, is it only increasing over time?
Yes. Well, I should say it's kind of strange because you have a lot of OTC products now, but actually, if you look at the futures markets, the open interest and volume levels have been declining since 2020, since COVID, but the structured product vehicle market has expanded as all this money created back in 2020, 2021, that type of time frame, the explosion in money supply you've seen is an explosion in derivative activity in structured product vehicles and creation and that type of thing. So that's kind of gone hand in hand. And you can kind of see that it's almost like these structured products kind of act as this big rubber band that kind of flexes as all this money is created and people go, I want to buy gold. I'm an institution. I want to buy gold. And they go to their investment committee, for example, and the investment committee says, well, we really can't buy the physical because our charter says we can't go physical, but we can buy an ETF or we can buy a structured product that's created by a big investment house. Kind of like the Big Short when Michael Berry goes to Goldman Sachs and says, I want to buy a contract on shorting the housing market or the mortgage market. Well, it's a very similar structure. They're going and buying structured products that are sort of tailored to that institution's needs. And Wall Street makes money doing that. And so there's different ways to sort of skin the cat.
You mentioned the big players, and I believe you have a chart on this, let's say the growth of derivatives over time in the article, right?
Yeah.
If you just scroll down to show that chart of the growth of the derivatives over time. But I was going to ask you, you mentioned these big players that want to come in and have some price exposure to the metals. Are a lot of them mandated to actually only buy these type of structured products over actual physical commodities?
A lot of them are. Problem with physical commodities is they're not a fund and they're not a security. And a lot of charters require, from an auditing standpoint, it's easier to buy a fund or security that's housed at an investment bank or brokerage, broker-dealer, especially from an auditing standpoint, because you're not taking direct custody and control. You have a custodian that's holding it for you. Custodian has gone through all those audit measures and so forth and compliance. So the auditors feel comfortable that there's reduced risk of insider theft or manipulation of someone's own statements, that type of thing. So going with funds and securities is a way to sort of address some of these compliance concerns. And then also from a liquidity standpoint, it's easier to unload the ETF. The perception is it's easier to unload the ETF into the market if you're selling, $100 million of an ETF than it is to sell $100 million of a physical asset. Now, in all fairness, some of these real assets, that actually is very true. I mean, some of these asset classes don't have a lot of volume to it. I mean, if you look at the palladium market or even the platinum market, it's very small. It doesn't trade a lot. The spreads are wider, and that's very, very common. When you're looking at the gold market, in some instances, the silver market as well, they're both traded 24 hours a day. They're both very, very liquid. There's a lot of money that can be pushed into the physical gold market and pulled out of the physical gold market without doing too much damage to the price, so to speak. It's a very deep market. And there's this misperception, I guess you could say, that, well, the paper asset market just is a much better market for that because maybe the spreads aren't as wide and you have a cash market that the banks will support and provide maybe better bids because you got to remember, they're making money on spreads. They may be also a market maker. There's ancillary businesses that they get from creating that market structure as well, especially with ETFs. If they're an authorized participant, they create the shares. They can house those shares in inventory. They can loan against someone wants to short the market. They want to borrow shares. They can actually make money loaning those shares out. There's different types of business models that can be created as secondary and third type of ancillary offshoots of creating all this paper industry, you should say.
So, you mentioned in a way the advantage of having these proxies for real goods, not driving up the real price of the commodity. So does that end up being real advantage for, again, these big institutions that don't want to actually move the price, but want relative large price exposure?
Yeah, I think you probably nailed some of that right on the head there. BlackRock put 0.1% of the assets that they had in the silver market, the physical silver market. I mean, they would blow the market out of the water. And so you have this paper derivative market that sort of acts as a sponge that sort of absorbs a lot of this money flow, kind of influences the price action. So it allows some of these institutions to build a position without significantly either increasing price or significantly affecting the supply of the metal in the market. That could ultimately affect the industry's ability that may use it for production and fabrication. It may push them out of the market and force them to try to compete, or maybe have to pay higher prices for a product, that type of thing. And ultimately, you see this action resonate with the mining community because the price to pull that metal out of the ground is X, and it's only trading at Y, and that Y is below X. They're not making money. And you're seeing that with a lot of primary silver producers not being profitable here. Even at $22, $23 silver, their earnings were horrible. And then you see the production levels not increase because, well, if the price doesn't go up to a level they can make money at, why even bother increasing production? Why does it give them any incentive to go out and search and explore for more metal or more veins and discoveries, that type of thing? Because it's just too costly maybe to pull that metal out of the ground. And that all feeds on itself in the physical world. And that's partly the derivatives market is to blame for that.
So going back to these UCITS products, do they actually own any underlying metals?
And own underlying metals, but the problem is the fund can't take delivery of that. And so you may have an instance where there is physical metal being put into, like you see electronic traded funds, for example, that's traded over in Europe. There may be funds that actually has physical product. In essence, UCITS fund can only invest in that ETF or ETP, and then they can only just trade it back out of the market. They're looking for price representation. They're not really looking for the actual metal. Most of these funds are not designed to look at, which we can go through later, the different risks that traditional investors in the market, retail and institutional or high net worth investors, buy physical metals for, in terms of counterparty risk, systemic risk, and all these other types of currency risk, that type of thing. Why they're buying the physical metal. The institutional market doesn't perceive those risks similar to an individual investor.
So what are, let's say, the associated risks with buying some of these products, Bob? Obviously, the fact that you cannot really exchange them for real metal would be one of them. But, it seems like there's a lot of layers of counterparty risk here.
That's why they created this industry, was to regulate and create more rules for derivative products that have more risk. I mean, instead of taking away layers of the onion, you're adding more layers of the onion and you're calling it safer. That's basically what's happening here. It's insanity. I mean, it's like whatever happened to just owning physical metal. Some people don't want the physical metal. They're wanting to just trade it. And that's great. And then there's a product, and Wall Street satisfies that trader's mentality or that investor's mentality by creating products that have very low spreads, easy to get in and out of, very low friction costs, that type of thing. The futures market is a vehicle for that. The ETF markets are also a vehicle, mining stocks, that type of thing. But for the realization of all this money printing, and you look at debt servicing and the potential of confidence starting to decline, the potential of recession down the road starting to grow and become more of a dominant theme, more realistic, I should say, because the statistics of the government can be massaged in almost any direction with all the statistical modeling and different types of ways they can, adjustments, seasonality, that type of thing, hedonics, that type of thing. So once that realization and that confidence starts to break down in the markets, the need for actual physical metal that's held outside the system becomes more apparent. But the problem is the more money that leaves the system that, for example, gets hoarded, so to speak, that's less money that's turning over. In reality, that's less collateralization, that's less leverage, and the system isn't designed for that. It's designed to grow to meet ever increasing debt service needs, ever increasing refinancing needs, and that type of thing.
So really, it seems like these financial products are a lot easier to run and probably much more profitable than running an actual depository. Is that correct?
Completely, because you don't have to have a forklift to lift your financial statement. Simple as that.
Or actual products around.
Exactly. Yeah.
I'd like to get into that side of stuff, but let's just kind of finish up this financial products. Did the Basel III regulations end up changing a lot of this landscape for banks as well, Bob?
Yeah. The Basel III basically disincentivized the leverage that banks use. And if we're just talking the gold market, for example, the idea of running these unallocated gold programs where basically the bank was saying they have a customer that says, I want to invest in gold. The bank goes, great. We got this unallocated program that, by the way, you don't have to pay any storage fees. And if the price of gold goes up, you benefit from it. And they're like, well, that sounds like the most wonderful thing in the world. Where do I sign up? They buy that program. But in essence, what that program basically says is, oh, by the way, in very, very small fine print, that you don't actually own gold and the assets, your investment is backed by our balance sheet, not by any segregated gold specifically designed to back that unallocated program that we just sold you. So what happens is if the banks fail, for example, the unallocated program is really just balance sheet financing mechanism that is now, that client's investment is a liability for the bank. And so if the bank goes under, their whole balance sheet could go under. And so the client not only doesn't have any gold, they invested in something that they thought they would be protecting themselves from that risk of actually happening. Well, they just went right down with the ship. So Basel III looked at trying to delever banks and the leverage that they were using because the industry isn't dumb. It's very forward looking. They see the money printing. They see the expansion of all this money supply and everything. And they see the growing increase of debt usage by governments and that type of thing. It just makes sense to try to not have a 2008 financial crisis all over again. So you try to put in regulations that reduce that overall leverage. And that's what was the attempt for. But in essence, this is why I keep saying what that's actually doing, though, is strengthening the underlying physical market because you're not having this massive overhang of leverage every time the market takes a drawdown. That leverage gets wiped out, that creates forced selling that then turns into prices declining a lot faster and a lot deeper than people think, like in 2008.
So to contrast this digital representation, let's say, of these products, what does it take to really run a depository?
Depository side is a unique business. I started my depository back in 2008. I looked at every risk that I could think of, and I still risks out there. Because as this industry evolves, it adds new complexities and layers to business models and things like that. But we can go through a chart real quick. Mm-hmm. So with our depository, which we started in 2008, we looked at a number of different risks, a number of different services. Part of being a depository is also you need to have redundancy in terms of whether it be shipping or client documentation, inventory management, that type of thing. So we kind of look at for the depository as storage, transportation, shipping, logistics, security are sort of the prominent features of a depository. Whereas if you're storing your GLD with a broker dealer, you're basically just saying, hey, listen, I know that broker dealer has the shares. It may be in street name. They show it in my statement, so therefore it must be there. And plus I have SIPC insurance protection in case something happens. So with a depository, insurance is a very big expense. And typically Lloyd's of London, which is the policy that we have, Lloyd's of London as a marketplace is the biggest influence or biggest provider of insurance in the vaulting industry because it's able to spread out risk through numerous different companies and syndicates worldwide. One company is actually, for example, our policy is a $700 million all risk insurance policy. To have one company and maybe a big company take on that entire risk could be detrimental or material if something happened to our facility. So Lloyd's will spread that out. So when you're looking at physical metal versus paper metal, most people need to make distinctions on ownership versus representation. This kind of simplifies it the most. I mean, you have, the guy who just buys the physical metal, stores it in a segregated account. That's ownership. No one can touch that metal except the client. But then you have unallocated or pooled funds. You have balance sheet financing operations where you go into a program that you don't get charged any storage fees. You don't really actually own any metal. Even in an allocated program, you could own part of a bar, like a 1,000-ounce silver bar. You may own 20 ounces of silver, but that 1,000-ounce silver bar, you can't actually take delivery of. You can just have that representation that I have 20 ounces of that 1,000-ounce bar. That's common with allocated programs, for example, or structured programs. But the balance sheet financing program, which a lot of companies use out there, is where you give company A money, they go ahead and buy silver with it. They can use that silver in the course of their production if they're a refiner or a mint, where they buy 1,000-ounce silver bars, they take it, they refine it down to 1-ounce rounds. They sell the 1-ounce rounds, and with the money, they go back and buy a 1,000-ounce silver bar again. But at any time, if you wanted out of that program, you could either say, listen, I want to cash out, or I want silver, for example. And what they would do is they would upcharge you whatever. They'd say, great, what product do you want? And you say, I want 1-ounce rounds. You're going to pay the premium for those 1-ounce rounds. They'll make the 1-ounce rounds for you, and then you'll get your silver. But in essence, though, they were using that metal in the course of business, making money off that without having to pay those investors in that program a dime of any interest or for borrowing that money, basically. So there's numerous ways that the industry operates in. And not all these programs, they use the word allocated very freely. These programs carry numerous risks associated with them as well, because we'll get into that. And that's just one quick note is like the bank unallocated program, creditor versus owner. That's probably a great way to explain some of these relationships. And when you get into that type of system, it's really an investment contract versus a commodity contract, because you're dependent on the promise of somebody else.
Right. And that's always what we talk about, you and I, is counterparty risk.
Definitely. Yeah. It just takes so many different forms. And I think that's what makes it difficult for the retail public, as well as even the institutional investor, trying to identify all these nuances of risks out there, because no one's an expert in the industry initially. They're all trying to do their due diligence, but they're doing their due diligence from, in a lot of instances, from the standpoint of a financial advisor mentality of, okay, I'm going to read the balance sheet, I'm going to read the offering memorandum, and that's what it says, so that's what they're going to abide by. But they don't understand the other complexities. So basically, with systemic risk, one of the reasons that brings a lot of people to the physical world is to diversify from the potential, like the 2008 financial crisis, where everything just hits the fan. You have this idea that counterparties start to collapse like dominoes. And so all of a sudden you have this actual systemic issue being driven, where whether it's insolvency or you just have inability to settle a trade, so to speak, because that counterparty that market maker was doing business with can't settle the trade against their market maker. So it's just a domino effect. But that's where owning physical metal held directly removes the systemic risk, because especially in a depository that's not owned by a gold dealer, a financial institution, or a cash in transit company that relies on transactional revenue and relies on the economy to drive their business model. In a systemic issue, you have to make the inference that the economy is going to be taking a big hit, and anything that's deriving their revenue from transactional business is going to get curtailed. So how will they be able to support their business model if a large leg of their business model gets taken out from underneath them? And then this gets into custodian, sub-custodian risk. With depositories, obviously 85 to 90% of the insider, let's say, losses within the depository are typically insider theft issues. And so understanding what the insurance covers, the exclusions of the policy, that type of thing. For example, fraud is typically an excluded item from most of the all-risk insurance policies. Great example was the First State Depository fiasco, where the allegations of fraud were kind of rampant, even though they had an all-risk policy, and the policy was very, very the limits were much more below what they were actually supposedly storing. That's another risk as well with custodians, is that they underinsure their exposure. In this instance, because it was actual fraud, that came under an exclusion. So they didn't have, the affected parties can't go after Lloyd's in that instance. But those are some of the risks associated with custodians. And then, like I tell people, the London market, and this is English law in London, is if the custodian is storing their metals with a sub-custodian and the sub-custodian loses their metals, the custodian cannot sue the sub-custodian, cannot hold them responsible. And I was like, this is the most craziest thing in the world. Why the hell would they ever have that clause? And it turns out that the Bank of England is widely used as a sub-custodian for a lot of banks out there. So then the Bank of England, like most government institutions, can't be sued or has that, forget the terminology, it'll come back to me, but they have a lot of governments. I'll get back to that. Offerings and agreements, it's critical to read all the responsibilities and liabilities of not only custodian to the client, but also the client's responsibilities to the custodian. And so everyone obviously likes to save money out there, but read the agreements. It's going to open up. You want to look for limits of liability clauses, hold harmless agreements, things like that. Ignore whatever the company or the program is using from a marketing perspective that you see on the website. Just throw that out. Totally ignore their advertising claims and read the agreement. The agreement is the only thing that's going to stand up in a court of law in case something does happen. And like any asset or investment out there, you have to really look at the risks in the event of, this is why we're buying metal, because we're expecting potential uncertainty to come into the market. And that uncertainty can actually have a wide-reaching effect. And knowing what your ability to get recourse from in case something happens to the depository, I think is critical right from the get-go. Because the last thing you want to do is start moving metals around, saying, okay, a year into it, you go, I really don't like the depository. I just read the terminology. I can't take in the court, for example. They don't allow a jury trial, which is in a lot of these contracts. And so, then you have to pay for the cost of moving the metal. So it can be a costly endeavor.
Bob, what about, let's say, jurisdictional risk? You brought up the idea of London, but let's say, contrasting London versus Idaho, for example, and storing your metals in these different jurisdictions.
Yeah. With our facility, there is no required tax ID number or social security number to establish an account. It's very private because what we're doing is we're storing a personal asset. Whereas if you set up an account, for example, in London or in a financial center that's going to be heavily regulated because maybe the institution that you're storing with has a lot of compliance and oversight that they have to, because of all the businesses that they're servicing, and they're required to take in a lot more information. The client is actually having to provide a lot more private information to a company. Now, in this day and age, throws in a whole new risk. I don't even have listed here, but cybersecurity. When you're starting to give over your tax ID information, your birth date, credit card information, all these things potentially could be hacked, now can add more complexity and risk of the customer's day-to-day living. Not necessarily their metals are fine, but now all of a sudden somebody has their privacy information that they received because a cybersecurity or server wasn't protected, or there was a intrusion into that firm's network, so to speak. Mm-hmm. Fee discrimination is a big issue in the industry. You see this with self-directed IRA accounts versus regular accounts. So in a self-directed IRA account, a lot of depositories will offer these extremely low fee rates, tend to have these exclusive arrangements with a lot of these self-directed IRA custodians because they're collecting the assets, and the motivation could be different depending on the company, but it's allowing the self-directed IRA company to market and try to grow their asset structure. But at the same time, a lot of these depositories that are being used are owned by wholesalers, and the wholesalers will get ancillary business from the transfer, the buy and the sell of the metals, shipping costs, that type of thing. There's other ancillary fees that can be driven from that. So it's sort of like giving away, like in the razor blade scenario, giving away the handle in order to keep selling razor blades in a way. So some of that business model, it could be lucrative because it tries to capture that transaction. So when it gets sold, that wholesaler that's providing that storage depository may get that transaction, settle the trade, and be able to make more money on the spread. That's just one thing. But the dichotomy between what the depository charges for the exact same metal, whether it's an IRA or if it's a non-IRA, could be 15 basis points they're charging for an IRA for an account versus they may be charging up to 1.5 percentage points, 10 times that rate for a private account. And so you have to ask yourself, how are they covering all of these expenses? Is one account vastly underpaying for storage versus the other account vastly overpaying for storage? Those are the issues that clients would have to ask themselves. And again, this is not stuff that you can just look at simply a normal storage agreement, because these IRA companies have their own agreements with the depositories. Mm-hmm. With methods of storage, it's important to understand, the differences between unallocated, allocated, segregated. In our industry, allocated is a very commonly used form of storage. And I'll go through one scenario. For example, a gold dealer may have a master account with, say, a large depository. In that instance, they have their own pile, so their client's pile, stored in a section of the vault. To them, that's segregated. To the client, they have a sub-account with the gold dealer, and that gold dealer now has, the gold dealer's client now has what they call an allocated relationship with the gold dealer, so they don't really have a direct relationship with the depository. So in essence, if they own a 100-ounce bar, for example, and they want delivery and they can't get a hold of the gold dealer and they go to call the depository is going to say, "Who are you? We don't know who you are." And so that's one method of allocated. The gold dealer may try to sell that program as a segregated product because in their mind, it's segregated because the group of metal is actually held separate and apart from, say, the next guy in the same vault. It may be, whether it's in the next cage over, whatever it may be. But that's important to make that distinction. And reading the storage agreement will help identify that. Segregated is basically where client has direct relationship with the depository. The depository holds that metal separate and apart from everybody else's metals in the facility. They get back the exact same product that they originally had deposited with that depository. And the client has complete control over that account. So no one can touch that account unless the client gives instructions to. Then you have, again, this is the direct versus indirect relationship with the client and the interaction with the depository. Again, the master sub relationship is a very common element where the client has an indirect relationship through a middleman. And it could be a gold dealer, it could be a structured product company. This is a very, very common theme. A lot of gold dealers, especially the last 5-10 years, created these ideas that you can store your metal anywhere around the world and will basically aggregate your holdings and provide accounting for that. So in essence, the client goes, "Well, that's great. It's convenient. Then all of a sudden in that relationship, the client has created a closed loop type of relationship where when they go sell the metals, they can only go back through that program. They don't have the opportunity to say, "Well, you're giving me a really bad price on the sellback. I want to go to this guy who's giving me who's offering a lot better price." You can't do that. And that's one of the issues with working through middlemen. Whereas if you had a direct relationship with the depository, you could sell your metals to any dealer out there. Like, for example, with our depository, the reason why I created it was on behalf of, if I was the customer, I want to be able, when I sell back, I want to have the freedom to sell back whoever I want to. For example, we'll buy back the metals as well, but if our price isn't as great and there's more incentive after the shipping and insurance to sell through dealer A, for example, it forces us to be more competitive, but it provides the client to basically work what's in their best interest, not necessarily the best interest of the sponsor. Mm-hmm. And then you have counterparty and conflict of interest risk. Again, this is where the vaults program or the sponsors program may be at conflict with what their client base, what their interests are. In terms of, you have to look at financial strength of going concern risk, that type of thing, but the financial strength of the sponsor. You have, for example, one program that's very, very well known in the industry that's been dumping their gold and silver out of their balance sheet and buying commercial real estate with it. And so their program is sold on the idea that they're protecting the client's best interests, and their interests are aligned with their clients. Why would they be selling their precious metals and buying commercial real estate? Because as a precious metals investor, one of your concerns is, well, if things become uncertain and the economy breaks down, commercial real estate may be one of the things that's greatly affected. So it's understanding the business structure of the company you're doing business with.
Right.
And then looking at available documents, again, trying to get the evidence of insurance from whoever you're storing with. If they offer financials of the company, the client can get an idea, okay, how strong is this company? What's their, for example, their deductible on their insurance policy versus how much they have cash on hand to meet not only the deductible if something happens, but also day-to-day expenses. So in our industry, it's very common to see a very high deductible type policy because most of these firms out there, they either self-insure the losses or their probability is saying, listen, I don't think we're going to have a major loss, but the insurance is there for catastrophic purposes. So we may just put in $100,000 or $200,000 deductible to get that rate, our premium down. But in essence, if we did have a loss, that's $200,000, for example, we got to cough up out of our own pocket. That's important for a customer to know. And that's why, for example, again, I looked at and created a depository as if I was the customer. And so our deductible, which is one of the lowest in the world, is only $10,000. And so in our balance sheet, we do provide to clients a copy of our year-end balance sheet of the most recent fiscal year, so people can get a better feel of transparency of who we are and what kind of risks they're taking. And I think that's all part of my theme of, if I was a client, this is what I would want to see. Well, this is what we do for our clients.
Absolutely. And I think, again, that's not necessarily trying to promote just you guys, but making sure that we understand what the risks are and understand what the mitigation of those risks looks like so that you have confidence in storing your metal outside your own home.
Right. And that's a great thought, because a lot of people, if you don't own it, you don't hold it, you don't own it. And I agree with that concept. That's why that bleeds over into the depository side. You could kind of make that same inference. If it's not held directly, you may not be, the full owner or have legal title to that metal. It could turn into an investment contract or some type of promise or liability of the sponsor. And that's important to understand those distinct features. Mm-hmm. Again, this is the risks of transparency going concern. Again, the idea of being able to try to get as much information on the company you're doing business with, and not just that company, but also its affiliates as well. And that's hard to do. I mean, trying to dig up the Secretary of State's business, whoever the agent is, or whoever owns that company, looking at and see if they own other companies and what kind of dependency each one of these companies has on itself. And then is there a master company that basically oversees all the other companies? So then all of a sudden you have, if the master company becomes insolvent, how is that going to affect the subsidiary that maybe you're doing business with? Those are all sort of features to watch for. And then you get into, this is the idea of foreign storage for U.S. investors, which became very popular about 8 years ago, saying, okay, I'm going to move my metals out because I don't trust the U.S. government, which I get that. And we created, actually, we were one of the first U.S. companies to start storing in Singapore back in 2011. But for the U.S.-based investor, they have to understand, in a lot of these instances, the metal isn't really held directly, completely. There's also footnotes to being held directly versus indirectly. And if it's not held to the standard of the IRS and FinCEN, then all of a sudden you have reporting requirements that you have to report those metals every single year to the government. And if you don't, there's hefty fines associated with that. And that's very critical to understand, because there's a lot of companies on the foreign side that say, yeah, you don't have to report these holdings because they're held directly. But in essence, part of held directly is that if a company where you're storing the metals at have an insurable interest in that metals, or they can touch those metals, take metals in or add metals to that account, that may fail that held directly argument. So then all of a sudden, if you're not reporting that holding, you're looking at massive fines, and those fines are cumulative over every year you never submitted those reports. Mm-hmm. And then, for foreign investors looking for storage in the US, want to look at where you're storing. There's some nuances. The biggest thing is taxation. So certain states actually will charge sales tax, usage tax, value-added tax, or goods and services tax. So if you're buying metals and you're storing in New Jersey, for example, there may be a sales tax associated with storing in that state. So if you're importing metals, or if you're wanting to say you're an Australian citizen and you don't trust the Australian government for some reason and you want to store in the US, just knowing which state you're storing in actually can have an effect. Not all states and regulations are the same. And that's very common with foreign countries as well. And then confiscation is kind of a big buzzword that the industry uses. And I think it's a little bit disingenuous from a confiscation standpoint. You have gold dealers that will push pre-33 gold coins because they say this, based on the laws that were created back in 33, that if you had a coin that was worth more than 15% of the metallic content of the coin, it'd be a collectible. So therefore that was outside the realm of confiscation. In reality, we were on a gold standard back then. Today, we're not on a gold standard, and most people don't own gold. And in essence, really, confiscation, I think, is going to be basically through taxation, which confiscation happens, actually, it's easier to do with electronic assets and bank accounts like we saw with Canada than it is with physical assets. And in essence, confiscation will just be with price increases and inflation, and then the taxation of those capital gains when the client sells those assets. That's how the government's going to get their money back. Mm-hmm. Privacy is a big thing. Obviously, this kind of goes in regard to capital controls, that type of thing, reporting requirements. But again, like I said, client privacy, their information, actually, the security of that information is critical in terms of social security numbers, birth dates, things like that are required by a program to open an account. How is that being stored and how is that being protected? And then I guess transparency, going concern, I think that we already went through that. Political risks, actually, that's actually a really hot topic, especially when you're storing overseas. And then obviously it really became into fashion when you looked at what happened with COVID and the lockdowns and the government intrusive policies that sort of made movement and transporting and transacting a lot more difficult. So these are things that, people need to look at and consider if you're storing outside your house, for example. And even if you're storing inside your house, these are things to consider as well. Because if you live in a state, for example, that does charge sales tax, you're paying a sales tax every time you receive metals, for example, from your dealer. And so that's an added cost that you may have to incur. Force majeure is a very big clause in every storage agreement out there, including ours. And that basically, force majeure is basically when something happens beyond one's control. And this is typically, you have war, you have insurrection, you have weather, like for example, a hurricane comes out of nowhere. And so all of a sudden you can't get to your assets, or the depository can't ship those out because the courier can't work in a safe condition, or there's a union strike. And so the metals have to be held until that strike is over. Different types of things. And those typically, like in our contract, we spell out what those items are. So that way the client can get an idea what's not covered versus just saying, we have an all risk policy, because, an all risk policy is a little sometimes misinforming the customer, meaning when you say all risk, you're thinking every risk out there is covered. Well, all risk except for is typically, you should read it. Again, contract provisions, the hold harmless limits of liability clauses, definitely look into that. The notification of changes is a big thing. A lot of these companies will say, listen, as long as we post our change to our website, consider that notification of change. And then within 30 days, if you don't do anything, that goes into effect. Something of that nature. And most people don't check the website every single day. Typically you'd want to see it like in an email or something in writing directly to the customer. But these are important things to consider because, again, the program is creating a process that's easiest for them, not necessarily as beneficial for the customer to get that transparency. Delivery, the use of various couriers. One of the things at Depository is, how well they can distribute that product upon demand. If they can use freight for larger clients, if they can use different couriers for smaller clients. We also, at our facility, we have a fleet of armored vehicles that we can actually deliver product in the lower 48 states into a residential environment up to $10 million in the vehicle. So we can cater to the high net worth individual that says, I don't want to store it at my house, but if I ever need it, I can call you guys and you can deliver it to me. And that's most commercial armored car companies do not go into residential environments. So that's something to also consider. Social chaos, which is a big thing. This tends to have more of an effect when you're storing metals in a financial center or a big city. The idea that all of a sudden you may not be able to drive up to pick up your stuff, or you may be able to drive and pick it up. But the question is, can you walk 10 feet out the door without getting clubbed over the head and your stuff being taken? Or the ability for the provider to safely move product from their location onto the street and then ultimately to the customer or to a courier. So these are things to watch for. Authenticity, purity of product, that type of thing. That's a big issue as well. Making sure that depository, when you buy your metals, product is verified, or you're buying it from a location or a dealer that's highly regarded, that, in terms of getting their metals, they have a chain of custody typically in the dealer industry. You have the refiner or mint that makes a product. You have distributors like the wholesalers that have the agreements to distribute that product directly from refiner, and then that product then gets delivered to retail dealers or to depositories. But having that chain of custody is critical. Again, these are just a few other types of phrases to watch for. When I was referring back to the governments running depositories, and you see this with the state of Texas, for example, or with any government depository out there, there's what they call a sovereign immunity clause, where basically you cannot sue the government. And most people think, well, God, this program is supported by the state government or federal government or some province, whatever it may be. They must be great. It must be safe. But in essence, if you read the agreement, they may have something in there that says, listen, if there's sovereign immunity and they lose your metals, you can't sue them. How good is that program at that point? Especially if the program is subbing out that work to a private company, which makes it even more layers of risk there. Looking for the term no warranty, watch for those types of legal clauses that basically, they may have 15 paragraphs in their storage agreement. The first 14 sound great, and the last one says, oh, by the way, if we lose everything, you're out of luck. Well, that basically negates the first 14 clauses. So just understanding that. And then also accessibility, flexibility. You want to, having that direct relationship with the depository allows the customer to be able to contact, interact with, and then ultimately, whether they want to deliver to the depository or actually want to take delivery from the depository, how easy, what the length of time is, that type of thing. Those are all questions to really ask as well. And that's basically it. That's me when I had more hair.
Well, I'm jealous, Bob. Well, as usual, Bob, I really appreciate you helping run through and really try to understand and highlight all of the risks associated with these different, let's say, if it's an allocated program, unallocated program, a physical type of risk, and or the derivative side of it as well. And I appreciate you walking us through that.
Sure, no, my pleasure. And again, we've touched on just a few things here. There's obviously a lot more, and individuals have questions, feel free to contact us or see our website, goldsilvervault.com, or I put out stuff on Twitter, Profits Plus ID, in terms of educational information, just to try and enlighten the investor out there that's interested in precious metals. Again, I want to support the industry. I want to support the client base, the investors out there, because the more education we can maybe throw out there as an industry, the more the customer or potential customer is going to feel more comfortable and will want to invest in that asset class, which, the real asset class is what's going to end up helping the full chain of, from mining operations all the way through to minting, refining. That's the industry. The problem is the derivative markets really curtail, I think, the mining industry and allow sort of handcuffs the price action, which ultimately you see in balance sheet revenue and income numbers of a lot of these mining companies.
Excellent, Bob. Well, again, thanks for walking us through all of these or some of these different risks.
Sure. My pleasure. Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.